Just got the most incredible email update from CoreLogic. So today I'm going to geek out on the data like I like to do every now and then. I've got my little laptop in front of me here with a heap of notes. Now, a lot of this video is going to be me reading through some of CoreLogic's thoughts on the Australian marketplace pre-coronavirus, post-coronavirus, and what lies ahead for the Australian economy and the Australian property market. So get your pen, get your pad out, and let's geek it out for a little while together.
Now, I've been seeing so much positive news coming out basically daily, reading these articles from either SQM, Michael Matusik, CoreLogic, Phil Anderson, Catherine Cashmore. We've got such good exposure to all of these different people, but when we got this one on the 25th of May, some interesting reads, a very interesting read it is. So really excited to share this with everyone.
You know, the first thing everyone needs to know about this current market is it's not a time for everyone. It's not a time for those of you that don't have a buffer in place, that are going to put everything on the line, that may lose their job. But for those of you like myself and Simon who are in strong financial positions, have some savings in the bank, and can comfortably continue to move forward with our lives financially, which is actually 85% of you listening to this right now, because 100% of people through this virus have felt like they should be affected, but only 15% of people, maybe 20% of households have actually economically been affected. I don't know about you guys, but I've saved a shitload of money through this time because I'm not spending money on clothes, I'm not spending money on movies, I'm not spending any money on unnecessary food, like I'm not spending any money on alcohol. It's just, I'm saving an absolute fortune through those things. I'm not socializing as much, so I'm not blowing money that way either.
It's nice to just see things going up a little bit faster than usual, and just going to mean we can all achieve our goals a little bit sooner.
So this is from Eliza Owen, the Head of Research Australia for CoreLogic. Now, she said there are some reasons to be optimistic about Australian property in 2020. There are also some key vulnerabilities in our economy. Now, she said, historically negative economic shocks have seen dwelling values in Australia in terms of houses relatively insulated. However, transaction activity has often been more impacted. So we're noticing the same thing at the moment, where obviously property prices, if you look at SQM or CoreLogic's data, haven't really adjusted too much so far as a result of the virus, but sales volumes are massively down by over 40% since this time last April.
Exactly.
So the economic outlook for the Australian economy prior to COVID was moderately positive. They were expecting growth through 2020, and then because prices in Sydney and Melbourne would have been so expensive relative to income, they would have seen a bit of a tapering off or a bit of a flatlining in those particular markets. But obviously the entire marketplace globally and economically has shifted as a result of COVID, and that's what the rest of this email talks through.
Now, obviously there's been lots of restrictions through this COVID situation, and now we're starting to see a few of them being eased. But what Eliza said here is the most impactful restrictions on Australian real estate commenced between the 20th and 25th of March. These include the closure of borders, a shutdown of non-essential services, a ban on open real estate inspections and on-site auctions, and limiting public gatherings to 2 people. Now, by mid-May, on-site auctions were reinstated in most states and territories, and property inspections are gradually opening up. But new housing demand is likely to see continued decline as borders remain closed to overseas migration and unemployment rises.
You know, so some of the threats that we've seen outside of just that, and the biggest ones I see to Australian property, is lack of immigration, because we're expecting 400,000 new Australians to move in this year to pick up all of the oversupply in Sydney and Melbourne, and that's just not going to happen. We've also lost the tourists, which represent a part of our gross domestic product, and we've lost the international students, which represent another part. So as well as the short-term rental market for Airbnbs. So the combination of those things means that vacancy rates in certain states, particularly Sydney and Melbourne, are gone up. There was another report that I looked at last week around which marketplaces are most exposed and vulnerable. Melbourne was number 1, Sydney was number 2. They believe that Queensland and Brisbane will be relatively well insulated because 1, we have mining, 2, our industry or economy isn't as reliant on the financial services industries as some of the others that have been smashed in Sydney and Melbourne. And the major reason being house prices are just so affordable up here still. You know, we haven't seen meaningful growth up here for almost 12 years now, according to CoreLogic. So it puts a buffer in place where people aren't overexposed on their home loans like some households are in Sydney and Melbourne, and therefore job losses become more serious down there.
Exactly. So in times like these, you just got to make sure that you're doing your research and due diligence and not just jumping straight in the deep end.
Now, they go on to talk about the fallout from COVID. An important consideration for the Australian economy is its labour force, with 97.4% of Australian businesses made up of less than 20 people. Now, that represents some unstable times because most small businesses don't have buffers in place or systems in place to protect themselves in these sorts of markets. You know, the beautiful thing about Pumped on Property is we've been talking about this marketplace for literally 3 years online. We knew it was coming. I sold a number of properties in preparation. Last year, we massively reduced the overhead expenses in our business in preparation for this marketplace. That enabled us to move through it differently, change to messaging, and to continue to move forward in a positive way, where a lot of businesses were completely blindsided by this and therefore have been hurt, which means laying off staff, potentially, moving out or not paying office leases and things like that.
Yeah, and having the ability to prepare for this and build up your general business account allows you to weather the storm a little bit easier. But if you were just hit by this, like a lot of people were, a lot of gyms, private gyms, a lot of restaurants, cafes, things like that, it happened so fast. I had some friends in Sydney that just opened a business and have had to shut the doors and had such great plans but can't do anything now because of this. So there is going to be a roll-on from that.
In terms of unemployment, almost 600,000 Australians now are unemployed, which has increased our rate in April to 6.2%. And I believe they're cooking the books, the Australian government, at the moment on that. I think unemployment's much higher personally. The underemployment rate reached a record high since they started collecting data in April, jumping from 4.9 to 13.7%. So there's a lot of households out there that were on the fringes. If you're working in hospitality, retail, tourism, or the arts space or the entertainment space, a lot of those households have been crushed, which luckily the government stepped in and provided some money through this JobKeeper scheme. Something that you said to me on Monday was huge, bro, and that is they put aside a massive amount of money for this, but $70 billion worth of JobKeeper scheme hasn't been uptaken.
Essentially overcalculated.
Massively overcalculated, which is a beautiful thing, but sort of like a double-edged sword because the government had sort of expected that money to go back into the economy. So it's nice that they've got some cash left up their sleeve for 6 months from now if things get better or worse. But it's also kind of like a double-edged sword because that $70 billion of new money will now not go into the economy until later in the year.
Exactly.
So what is happening to residential real estate amid COVID-19? So on March 17, CoreLogic put out an article and the findings were negative economic shocks do not necessarily lead to severe declines in property prices. Now, that is true for the mid-cycle slowdown point, but at the top of the cycle, which CoreLogic never talks about, property prices can get wiped out. So I'm so grateful that we're in this mid part as opposed to top of cycle. Property does not see the same declines as shares during a downturn. This is historically true based on 300 years of Phil Anderson and Fred Harrison's work. Stocks normally in the mid-cycle component come down between 20 and 50%. Property prices might not move at all, down to 15%. In the top of the market, we generally see stock markets decline by at least 60% and housing prices come back by an average of 40%. So that's the next one, and that's the one you've got to be more aware of, because that is a much, much heavier, brutal market compared to the one we're in now.
Especially for the average person.
Due to the temporal nature of the coronavirus downturn, vendors may hold on to high expectations. So a lot of people expected people to be forced to sell, but that's just not happening because they can freeze bank loans, they can get bailout money for their business, they can get bailout money through JobKeeper or JobSeeker. for themselves.
Pause on your home loans.
Pause the home loans as well. So, you know, some people, myself included, like I wouldn't be selling a property right now personally unless I was really forced to sell it. And a lot of people like that. So the expectation is it's going to be a sharp decline with a sharp bounce back. And whether that's true or not, that's the mentality of most Australians at this stage still.
I was even watching the ABC News this morning and they had their economist come on and he was also saying publicly that he believes it's going to be a really sharp recovery, and he sort of sees it occurring at the start of next year.
Yeah, you know, Commonwealth Bank and the International Monetary Fund are sort of stating that by the December quarter, like the last quarter of this year, we'll start to see things moving in a positive direction. I personally think it's going to be the start of next year to mid next year, you know, before the overarching economy looks to be heading in that direction. It's crazy. Like they're even talking now that we may avoid an actual recession because it's just going to be one really negative quarter of growth, not two. And that's just a tribute. Thank you, Australian government, for like stepping in and doing what you had to do really quickly. I'm very, very proud to be an Australian at this stage where we had good money management leading up to this, which enabled us to get out of this a lot sooner than other countries around the world. The fact that we also have commodities under the ground, gas, oil, iron ore, gold, etc. You know, countries with commodities normally get out of these things while they still have them underground much better. Just because the world needs our product and we are able to export that along with our beautiful livestock and food, which, you know, helps Australia in so many ways that other countries around the world don't have. We also have a huge tourism and student market, which will come back over time, and that's powerful as well.
Exactly. It's going to be interesting once they do open up the borders internationally again to see what the international immigration is going to look like, because I'm assuming the government's just going to say, come on in. And all of these things, you know, are big positives for people that are living overseas at the moment. And why wouldn't you want to come to a place where you've got such a good government making great decisions and
free healthcare, free education?
Exactly, you know, good property prices as well, and really good job prospects.
You know, what I saw when I looked back historically and in the GFC from a population perspective, you know, because you've got to look back at the past to remember the future. You know, you don't have to keep going blind into your future. You can learn. And I saw that in those peak years, government spending obviously went up, interest rates came down, which are two things they're doing at the moment. And then as soon as they were able to, they just flooded Australia. In 2 years during the GFC, they let 900,000 or 950,000 new Australians into the country. I believe that between 2021 and 2023, we are just going to see some of the most intense immigration that we've ever seen into Australia to get the show back on the road. So they go on to say that to date, housing values have only shown a marginal or a small decline. In April, I think 5 or 6 of the 8 capital cities went up in value. Now, the thing you've got to be aware of in these markets is the media is going to grab the headline saying that prices are going down. But because 70% of Australia's housing market is in Sydney and Melbourne, when Sydney and Melbourne declined by 5%, the whole Australian property market looks like it's declined by 3%. If they decline by 15% this year, it'll look like property prices in Australia have gone down by 10%. But we know that Sydney and Melbourne and Brisbane and Perth and Darwin are all so different. And places like Perth and Brisbane that are cheaper to buy than they were 10 years ago are very, very different to Sydney and Melbourne that are 100% more expensive. Sales volumes have fallen by over 40%. This happens, people get scared, they stop doing stuff.
I would say buyer activity's probably fallen around the same amount as well, but they haven't gone to say that.
You know, for us as a business, 70% of the properties we're inspecting at the moment are off market. So if you've got relationships like we do, there is incredibly good quality property. Simon's looking at a third property in 18 months for himself, the Savo, which I believe is 50 grand below what it should be.
Yeah, I mean, an off-market property.
The CoreLogic valuation priced it at 620 and it looks like you'll be able to buy it at 550.
Yeah.
So that's a 70 grand immediate equity uplift. The property that I bought last week, land is selling in that area a couple of years ago for 415K. I just picked it up for 340,000. So there are absolute steals around at the moment if you can stomach buying, and if you're in a safe and strong financial position to be able to do so.
Yeah, this has been a common trend for a lot of the properties that we've been buying at the moment as well. It's a very, very similar story. But now it is looking like things are starting to become a little bit tougher in terms of the purchasing, not as much negotiation in terms of the last week or so.
Yeah, we've noticed that people are starting to show up again.
Yeah.
Last week we inspected, or the week before that, 8 properties and 5 of them were sold within one day. Yeah. We haven't seen that sort of activity for about 12 weeks. So it's, slowly people's confidence is coming back. If you look on our website where you can book in a free strategy session, you'll see there's only a tiny number of those sessions available, because so many people from all over Australia and the world are booking them at the moment. Like, we're getting 20, 30 people reaching out to our business every week right now looking to buy Brisbane. It's, the biggest demand that we've ever seen in our lifetime in this business. In our lifetime, in our business. Rent prices are likely to be more affected than property prices. This is coming back to immigration, international students, and the extra Airbnb properties being put on, plus the shitload of properties that were being built in Sydney and Melbourne this year and next year that are going to come on as well. That's going to create a short-term oversupply in probably Darwin, Sydney, Melbourne. I think Perth as well. Brisbane vacancy rates are chronically undersupplied right now. So I think they'll hold still because not as many properties up there were on Airbnb.
Yeah, there'll be certain areas in certain markets that are going to be more affected than others. So just make sure you do your research again.
In terms of finance, which is an important early indicator for where things are tracking, prior to the onset of the coronavirus, housing finance conditions were becoming more accommodative, meaning they were starting to ease up. Now, this next phase, according to Phil Anderson, is lavish government spending on infrastructure as well as easy money. It looks like it's playing out exactly like that. So this was enabled through, a relaxation on the big picture macro measures that were in place, the cash rate being dropped to 0.25% of 1%. I just fixed a loan yesterday at 2.69%. When I started investing, I was paying 7.5%, and I thought that was a good rate.
Yeah, I was talking to our dad this morning as well, and he's just fixed part of his loan at 2.08%.
Insane.
I was laughing when he told me, just out of stupidity. I'm just like, how does that exist?
How does that exist?
His first home loan he got was at 18%, and now his last home loan's at 2%.
2.08%. Love it. They're basically reducing the assessment rate too. So between 2015 and 2019, it has been the hardest environment in Australian history to borrow money, which is what they did to slow down the Sydney and Melbourne property price growth, and it worked. Happen. But they're actually starting to relax those conditions that they put back in place then, which is coming into alignment with Phil's easy money thing. Now, it's still not easy because they're still looking at all of the little individual costs against people's lives after the Royal Banking Commission, but the Treasurer came out a week ago and said that they're looking to start relaxing that stuff now as well. All of these things, printing of money, lavish government spending, easy credit, easy assessments, confidence coming back in the market,
low interest rates,
stock markets crashing and people taking that money out and putting it into property, first-time buyers grants coming back into the market. They're playing with the idea of a $50,000 building grant at the moment for 10,000 Australians. All of this money for businesses is going to result in the biggest, I'm not joking, the biggest land run in global history around the world, with the $8 trillion worth of money that's being created out of literally thin air in this environment is going to result back into stocks and properties over the next 6-7 years. So just know that that's coming and learn about it.
What you've got to remember is once that money's created, it's in the market and it's going to end up back in the economy in one way or another. It's not just going to vanish in thin air. So, all of this money that's being poured into the coronavirus support is all going to end up back in the economy in one way or another. Phil Anderson talks about the idea of economic rent, where all of this money ends up back in land prices over time.
They go on to say that APRA is adopting measures to complement easier lending conditions in Corona-19. Like I read this shit and I'm just like, oh my God, Phil Anderson is a genius.
Honestly, it's crazy.
But he's not a genius. He just looked at 250 years worth of this stuff and saw patterns and processes. We've been able to do the same thing with what works when you buy residential property and how to beat the market averages. But he's done that from an overarching system level globally around, these 18 different steps in the clock over a 18-year period. And it's just unfolding like clockwork. It's so powerful. So, that's kind of their update. Some good news, some negative news. The news is going to be like that for the next year and a half. It's going to be positive and negative. I personally think that prices are going to come down a little bit in Sydney and Melbourne. I think they're going to come down the tiniest bit in Brisbane as a whole this year, but I still think it is one of the best buying opportunities in Brisbane in a decade by far. You're not just buying at the end of a low, but you're buying a 5 to 15% discount right now if you know how to get access to off-market listings. I'm super excited personally. Just bought a piece of land that I'm going to build on, renovating another property and building a granny flat later in the year.
We're all very active in the team. You've got that. You're planning to go another property this year. I'm about to get my third property within 18 months. Our other partner, Adam, he's just bought himself another house. Our sister, Crystal, is looking at buying another house this year as well. So this isn't stuff that we're just talking about. We are actually executing this and taking advantage of these current conditions, because I don't want to be the guy that says I should have, I could have, but I didn't.
For sure. So, if you're in a strong, safe position, fundamentals matter this year. Timing, houses with long-term potential for capital growth close to the city or the beach with big blocks of land. Cash flow is everything. Now, Simon and I aren't just going out there and buying properties and doing anything. The properties that we own are providing us with 5.5% to 7% rent returns after we add the granny flats to them. They're completely covering the expenses and producing, $10,000, $15,000 a year of passive income per property. So even if things start to slow down in our businesses or our jobs, we've still got a safe buffer in place to cover it. We want properties that you can add value to as well as one of the fundamentals. And I like to do properties that I can get some tax benefits on as well. Fundamentals really matter in these times. Definitely don't go rushing into Sydney and Melbourne anytime this year. Definitely don't go rushing into buying shitty units in those markets either. Stick to the quality blue chip stuff that's worked for hundreds of years in Australia, and you'll be much, much better off longer term as well.
Definitely.
Thank you, CoreLogic. You guys are the bomb.
Yeah.
Appreciate it. Hope you guys have geeked out on this one. Please subscribe to our channel below. Please follow us on Instagram or like us on Facebook. We're constantly putting different, smaller snippet stuff on there as well. And check out the podcast, The Pumped On Property Show as well. Cheers, guys.